Hey everybody, so in this video, I'm going to talk about longer term debt and just why these interest rates are so important. So many people, they may have told you that when interest rates go up, it's bad for corporations because it costs more for them to borrow money. And those people, they're 100% right. But maybe you haven't visually seen this. So that's what I'm going to show you in this video. So I definitely suggest you guys stick around because this is very useful, although it may be a little bit dry. So in this video, I'm going to talk about Realty Income, and I'm actually looking at their 10K. So this company, I picked this company because they pay monthly dividends. So they need solid financing because they need to pay these dividends every single month. They don't want to be in a situation where they don't have cash to pay these dividends. So let's just go ahead. Let's look at one line item and then we'll just talk about this. So right here, it says 4.6% notes and then $500 was issued February 2014. Now, this is actually in millions. So this is $500 million. So on February 2014, they issued $500 million worth of bonds, and then they issued that at 4.6%, which is the interest that they're paying every year. Now, this is due in February of 2024. So let's just go ahead and calculate what they're actually paying. So I'm going to go ahead, pull up the calculator. And a lot of these notes, they pay interest semi-annually. So I'll kind of show you what we do here. So if we're paying semi-annually, this 4.6% actually becomes halved. So we're actually paying 2.3% because we're doing two payments, and this 4.6% rate, this is annualized. So, we're going to do 2.3%, and then we're going to divide this by 100 so that, now we have it in proper format. Now we're going to multiply it by 500 million. So the money that is coming out of this company's pocket is 11.5 million every 6 months for this one note. Now, this 4.6% interest, this heavily depends on what is going on in the markets. So in February 2014, interest rates, they were about this high. Now let's just come up with a scenario. Let's say in 2024, I'm just making this up, you guys. Let's say in 2024, interest rates are going to be 5.5%. So you guys saw that we paid 11.5 million every 6 months for this one note. Now, if it's 5.5%, let's see how much we're paying. So we're going to do 0.055. We're going to divide that by 2 because it's semi-annual. And then we're going to multiply this by 500 million. So that is 13.75 million. And then we're going to subtract that by the 11,500,000 that we got before. So if interest rates are 5.5%, that would mean that we're paying $2.25 million more every 6 months. So if we're going to annualize that, we just got to multiply it by 2. That essentially means that we're paying $4.5 million more every single year if interest rates were 5.5%. So now you guys can get a good concept of why these interest rate hikes matter, because I'm going to tell you exactly what is likely to happen. So here in February 2024, this note, it's going to expire. So that essentially means that come February of 2024, they are going to have to pay all the note holders that money back. So they're going to pay the entire $500 million back. Now, how are they exactly going to do that? Well, they're likely not going to have cash prior to that. So what they're going to do is that they're probably going to issue another note. So In 2024, if interest rates are 5.5%, like I showed you in that example, then that means when they issue that new note to pay for this old note, then they're going to pay a higher rate of interest. So that is why this is very, very important. Now let's just look at some of these other examples here. Now let's go and look at this one right here. So they were paying 3.4% on $600 million notes. Now this is kind of unfortunate, you guys, because this was in June of 2020. Now take a look at this note right here. This was just several months after. Now remember, the Fed, they were cutting rates. So here it was 1.625%. So had they just waited just a little bit more, they would have been able to pay less interest on these notes. So definitely something to pay attention to. Now take a look at this right here. In December of 2020, those notes, they were only paying 0.75%. That's a fraction of a percent on interest. So here they got a pretty good deal because, they were able to finance themselves pretty cheaply. So definitely important. Now, let's just go ahead and just kind of see what actually happened. So here, in June, this is when they started kind of like recognizing that the markets were in terrible conditions and that they needed to stimulate the markets in some way. So they started cutting all these rates. Now here in late 2020 and 2021, we saw so many companies go public. That is because these rates were very, very low. So all of these companies were going public because, the markets, they were doing well. Stock market was doing well. And to finance yourself, it was very, very cheap, Like they're paying rates that were 1% or less basically here. So this is just giving you a very good idea of why these rates are so important. Now, if I actually wanted to look at the entirety of the interest expense, I could go ahead and go on page 59. So here we can see, it says right here, interest on credit facility, commercial paper, term loans, notes, mortgages, and interest rate swaps. So this is $320 million for 2021. Now, a lot of this amount is actually coming out of those notes that I showed you before. So after all is said and done, for this entire year, they paid $323 million in interest. So obviously, if they were paying lower interest rates, this interest expense would cut less into their profits. So this is basically a high level overview of interest rates and why these rate hikes are not favorable for corporations. I hope you guys enjoyed this video and definitely like and subscribe.